All right, let's jump right in. I want to talk about this really powerful idea that the rules of money are pretty much the same for everyone. Seriously, whether you're managing your own 401k or you're the CFO of a company like Apple, the basic principles of risk, return, and how you structure things, they're completely universal. Let's see how that works.
So let me ask you this. What could your house, your retirement fund, and a Fortune 500 company's balance sheet possibly have in common? I mean, on the surface, they seem like they're from different planets, right? But stick with me, because by the end of this, you're going to see they are all governed by the exact same set of financial rules. The whole secret is learning to see the hidden structure behind every money decision.
To get started, let's talk about a guy who knows a thing or two about money, Warren Buffett. He looked at the investing world and saw it was getting, well, just way too complicated. It was full of these high-fee managers who, more often than not, couldn't even beat the average market return. So his solution was, in a word, brilliant. And simple.
And this really gets to the heart of his thinking. What he's basically saying is, look, stop trying to be a genius. Stop trying to pick the next big stock. And definitely stop paying other people who claim they can. Instead, his advice is to just bet on the entire American economy as a whole. He argues that over the long haul, that's the most reliable way for most of us to build wealth.
And here is his actual game plan for doing it. It's the famous 90-10 portfolio. So, 90% of your money goes into a super low-cost fund that just mirrors the 500 biggest companies in the US. Think of this as your growth engine. The other 10%? That goes into short-term government bonds. That's your safety cushion, your shock absorber for when the ride gets a little bumpy.
And the perks of doing it this way, they are huge. First, you get access to the long-term growth of the stock market, which historically has returned about 10% a year. You're also automatically diversified across 500 huge companies, you save a ton of money on fees, and maybe the best part of all, it's pretty much a set-it-and-forget-it deal, which saves you a ton of time and stress.
Okay, so now let's zoom in on that little 10% slice of the pie. It might not look like the exciting part, but trust me, this is where one of the most crucial ideas in finance really comes to life. It's all about having a safety net, a plan for when things inevitably go wrong.
And to really get why this safety net works, we need to understand just one kind of nerdy word, correlation. It's just a fancy way of asking, when one of my investments zigs, what does the other one do? Does it zig with it, or does it zag? For a safety net, what you really want is something that zags when everything else is zigging down. That's called negative correlation.
And this is where it gets really interesting, because not all bonds are created equal, not even close. Corporate bonds, which is just debt from companies, they tend to move a little bit with stocks. If the economy is bad for stocks, it's often bad for those companies' bonds too. But government bonds? Whoa, a totally different animal. They tend to have a negative correlation. When investors panic, they sell stocks and they buy the perceived safety of U.S. government debt. We call this the flight to safety.
And you don't have to take my word for it. Just look at the 2008 financial crisis. It was a total bloodbath, right? The stock market got hammered, down 37%. Corporate bonds lost money too. But U.S. Treasury bonds, they actually made 13%. That is your safety net doing its job perfectly, at the exact moment you need it the most.
Okay, so we've seen how these principles help you structure an investment portfolio. But what about your house? Let's take that same way of thinking and apply it to one of the biggest decisions most of us ever face, renting versus buying. This isn't just a lifestyle question, it's a massive decision about how you allocate your capital.
When you look at it this way, the trade-offs get a lot clearer. Renting keeps your capital free. You could take all the money you would have used for a down payment and invest it in a diversified portfolio like that 90-10 strategy. Buying, on the other hand, means you're locking up a huge amount of capital in one single, illiquid asset. It's not about which one is better, it's about choosing the risk and reward structure that works for you. Now for the fun part. Let's scale this whole idea way up. Because believe it or not, a massive corporation with billions in the bank has the exact same fundamental problem you do with your savings account. They're sitting there looking at a giant pile of cash and asking, what the heck do we do with all this?
I mean, for a big company, letting mountains of cash just sit in a bank account is a losing strategy. First, there's the opportunity cost. That money could be out there earning a return. And then you've got the silent killer, inflation, just chewing away at the value of that cash every single day. So the puzzle for a CFO is how to get a return without taking on too much risk.
So what do? Well, they use a tiered approach that should sound really familiar. They keep some cash for daily bills, just like your checking account. They put their emergency fund into safe, short-term stuff like treasury bills. Sound familiar? And only the long-term extra cash gets put into riskier investments. It is literally the same logic you'd use, just with a few more zeros at the end.
So we've seen how you and giant corporations are basically wrestling with the same financial questions. But this brings up a much deeper question. Does how you structure all this stuff actually matter? Does it create value or does it just move it around? Well, a Nobel Prize-winning theory gives us an answer that is, well, it's probably not what you'd expect.
Get ready for this because it's a bit of a mind bender. The starting point of this entire theory is a shocking idea. In a perfect world, one with no taxes, no transaction fees, none of that messy real-world stuff, how a company is financed is completely irrelevant to its total value. Yeah, you heard that right. It makes no difference at all.
Now, of course, we don't live in a perfect world, but what these economists, Modigliani and Miller, did was genius. They created a baseline. By showing us that structure is irrelevant in a perfect world, they prove that if it does matter in our world, it can only be because of those real-world imperfections, things like taxes. They basically gave us a map of where to look to find real value.
And here is the big reveal. The moment you introduce just one of those real-world things, taxes, the whole picture flips upside down. In most places, when a company pays interest on its debt, it can deduct that interest payment from its taxes. This creates something called a tax shield. It's like the government is giving the company a discount coupon for using debt. So all of a sudden, taking on debt isn't just a financing choice, it's a way to literally add value to the company by saving money on taxes.
And that's the big takeaway from all of this. Structure is everything. Because we live in the real world, these choices aren't just about managing risk, they're about actively creating value. Choosing government bonds over corporate bonds changes your financial outcome in a crisis. Choosing to buy a house instead of rent changes how your capital works. And for a company, choosing debt over equity can make the entire company more valuable, all because of the tax code.
And that brings us right back to where we started. The principles really are universal. They scale from your bank account all the way up to a corporate balance sheet. So the only question left isn't for me, it's for you. Knowing these rules, what's the most important financial structure you need to build next?